Hey everyone, welcome back to Corporate Decoder. Today we are diving into Exxon Mobil's latest financial report, and let me tell you, it contains some very interesting numbers that might make you scratch your head. Before we jump in, if you love these kinds of deep dives into how big companies really operate, hit that subscribe button. And you might want to join our Discord server linked in the description below for more exclusive content and discussions. Now, Exxon Mobil, or Exxon as it is known on the stock market, has filed a report that gives us a peek at their financial situation, specifically around the beginning of 2026. It is not a full quarterly earnings report, but more of a snapshot of certain financial instruments. Think of it like checking the engine oil and tire pressure on a car. Not a full mechanics report, but still important. This filing is a standard update from a major corporation confirming their identity and domicile. They are incorporated in New Jersey and have a long history going back to 1926, making them a titan in the energy sector. The really interesting part of this filing isn't about a huge new business deal or a massive change in strategy. Instead, it is about updating information on some of their debt instruments. They're telling the world what they owe and when they plan to pay it back. This includes their common stock, of course, but also several notes, which is essentially just a fancy word for loans they've taken out from investors. We see notes maturing in 2028, 2032, and 2039. Understanding these debt obligations is crucial because it tells us about the company's financial leverage and its ability to manage its debt. Let's look at a couple of these notes. They have a 0.524% note due in 2028. Now that is a very low interest rate. If you borrowed money at that rate, you'd be getting a fantastic deal. It suggests that when they issued this debt, either interest rates were incredibly low or their creditworthiness was so high they could command very favorable terms. They also have a 0.524% note due in 2032. Again, the same unusually low interest rate. This indicates a consistent strategy of securing very cheap financing for the long term. It is smart financial management. And then we see a 1.408% note due in 2039. Still a very low rate, but a bit higher than the earlier ones. This is likely because it is a longer term loan. Generally, lenders demand a higher interest rate for lending money for a longer period because there is more uncertainty over time. This filing also mentions Exhibit 99.1, which is titled Exxon Mobil Corporation, the fourth quarter of 25 earnings considerations. This suggests that alongside this update on their debt, they were also thinking about their fourth quarter earnings for 2025. While this specific filing doesn't contain those detailed earnings, this reference implies that the debt they are reporting on could be influenced by, or is being considered in the context of their overall financial performance and future earnings. Investors will want to see how stable their earnings are to ensure they can continue to pay back their debts. Finally, one of the exhibits is an interactive data file. This means the way the information is presented is machine readable, making it easier for analysts and software to process and analyze the filings. It's a move towards greater transparency and efficiency in financial reporting. Now, taking a step back and looking at this filing as a whole, Exxon Mobil is clearly managing its debt very strategically. The extremely low interest rates on their notes indicate a company with strong financial standing and efficient access to capital markets. They are locking in low borrowing costs for the long haul, which can free up cash flow for other investments or to return to shareholders. This kind of financial maneuvering is a hallmark of a well-managed, mature company. However, while these low debt costs are a strength, it is always worth remembering that the energy sector is cyclical. Factors like oil prices, geopolitical events, and the global push towards renewable energy can significantly impact a company like Exxon Mobil. This filing doesn't detail those risks, but they are an ever-present consideration for any energy giant. In conclusion, this document, while not a typical deep dive into quarterly profits and losses, provides a clear picture of Exxon Mobil's prudent debt management. They are taking advantage of favorable market conditions to secure long-term, low-cost financing. This financial discipline, combined with their strategic positioning in the energy market, suggests a company that is well prepared to navigate the complexities of the global economy. What are your thoughts on Exxon Mobil's financial strategy? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate insights. Don't forget to check out the Discord community linked in the description. Thanks for watching, and we'll see you in the next one.